So, es kommt zwar die Sekunde noch eine ganze Reihe neuer Teilnehmer mit rein, aber wir wollten pünktlich um 17 Uhr beginnen. Insofern möge man mir verzeihen, wenn jetzt die ersten paar Minuten beitreten, diese großartige Begrüßung verpassen. Ich möchte alle Gäste herzlich begrüßen zu unserem heutigen Webinar Standortbestimmung nach der US-Wahl, Ausblick für Private Equity Investitionen. Mein Name ist Julien Zornig, ich bin einer der Gründungspartner hier von Astorius. Ich werde heute begleitet von meinem Partnerkollegen Oskar Volkland. And I have the pleasure to introduce Brian Gallagher and Matt Petroncio from our partner Twinbridge over in Chicago, who are going to share their views on the most recent week, a very astonishing week from many perspectives. And as discussed, I'm going to have a crisp introduction to Astorius first, die ich noch in Deutsch fortführen werde. Wir sind eine ganze Reihe Anmeldungen heute. Wir haben das Konzept des Webinars ja dieses Jahr auch für uns etwas mehr entdeckt. Heute mit einer Anmeldezahl von weit über 170 Teilnehmern, was uns sehr freut. Wir haben da offensichtlich auch den Puls der Zeit getroffen mit der Themenwahl des heutigen Tages und freuen uns eben mit unserem Kooperationspartner aus den USA, Twinbridge Capital, ein bisschen die Nachbereitung der bis jetzt vorliegenden Ergebnisse der US-Präsidentschaftswahl und einen gewissen Ausblick auf Mittelstandsbeteiligung im amerikanischen Markt mit euch heute zu diskutieren. Für den Verlauf des Webinars nutzt bitte gerne alle die Q&A-Taste, wo ihr Fragen stellen könnt. Wir werden verschiedene Teile heute behandeln und zum Abschluss gerne alle Fragen, die aufgekommen sind, mit den Kollegen von Twinbridge beantworten. Es wird kein Makroausblick sein, also wir werden keinen Euro-Dollar-Kurs für in 6 Monaten festlegen. Und dadurch, dass wir eine ganze Reihe von Teilnehmern haben, die uns eben noch nicht gut kennen, wir haben zwar Investoren dabei und Partner und Family Office, die mit uns arbeiten, aber auch eine ganze Reihe von Leuten, die vielleicht den Erstkontakt zu uns haben, wollen wir im ersten Teil vielleicht ganz kurz nochmal auf die Firma Astorius eingehen, was wir hier tun, dann in dem Hauptteil natürlich die Private Equity Implikationen der US-Wahl besprechen und im Abschluss einen Frage- und Antwortenteil mit einbauen. Kurz zu uns. Wir sind mittlerweile 8 Jahre alt. Wir sind ein Dachfondsanbieter aus Frankfurt und Hamburg, die ein Vermögen von über 700 Millionen Euro heute betreuen in den verwalteten Strategien. Und wir befinden uns in der 5. Generation europäischer Mittelstandsfonds eben im Fundraising und in der 1. Generation US-Mittelstand im Fundraising. Das ist ein Programm, das wir in Zusammenarbeit mit dem Partner Twinbridge Capital gemeinschaftlich verwalten, um die in den USA ansässigen Mittelstandsspezialisten bestmöglich auswählen zu können. Wir sind aktuell 13 Mitarbeiter und die Zahl, auf die wir immer am meisten Wert legen, ist das Eigeninvestment von den geschäftsführenden Gesellschaftern, das verpflichtend ist, und das zusätzliche freiwillige Investment aller Mitarbeiter, das uns zu einem der größten Investoren unserer eigenen Fonds macht. Das halten wir für eine ziemlich stilprägende Zahl im Marktvergleich. Kurz nochmal zu unserem Fokus. Wir sind letztlich in der Auswahl unserer Fonds, sowohl was unsere eigenverwalteten Europaprogramme als auch die mit Twinbridge gemeinschaftlich verwalteten US-Programme betrifft, ein mittelstandsfokussierter Investor. Das hat eine gewisse Logik, weil wir in den letzten Jahren immer wieder uns bestätigt sehen, dass der größte Teil des Geldzuflusses in den Private Equity Markt, in den Marktteil fließt, in dem die seltensten Transaktionen vorkommen. Das heißt, wir haben das Gefühl, dass von dem Risiko-Rendite-Profil das Segment, das wir hier hauptsächlich anbieten, das attraktivste im Bereich Private Markets ist. Dieses Paradoxon ist konstant über die letzten Jahre, auch im Rahmen unseres letzten Investorentages. Im September konnten wir auch die aktuellen frischen Marktdaten nehmen, die das wieder bestätigen, dass gerade im aktuellen Zinsumfeld, im Marktumfeld der Unsicherheit, die Hinwendung hin zu Private Markets weiter stabil hoch bleibt, aber der Fokus der meisten Investoren, gerade der großen Investoren, eben auf das Large-Cap-Segment dort vorliegt, was zu einem etwas anderen Preisniveau als bei uns führt. Wir haben kürzlich erst die Demarkationslinie von 100 indirekten Beteiligungen durchbrochen, was uns sehr stolz macht im Rahmen unserer verschiedenen Dachfondsprogramme, die wir seit 2013 aufgelegt haben. Wie vorhin schon gesagt, sind wir jetzt im 6. Dachfonds. Und von diesen 100 indirekten Beteiligungen wurden auch bereits 11 wieder veräußert. Bei diesen Veräußerungen wurde das eingesetzte Kapital im Schnitt mehr als vervierfacht, was eine sehr stolze Zahl ist. Und was uns aber genauso wichtig ist, zu diesem Multiplikationsfaktor. Wir haben dabei nicht einen einzigen Wertverlust realisiert und das inkludiert auch die jetzt auch schon 7 Monate anhaltende Corona-Krise. Wir fühlen uns also bestätigt, dass das, was wir hier an Risiko-Rendite-Profil als Mittelstandsinvestor anbieten, tatsächlich sehr attraktiv für uns und unsere Kunden ist. Zurzeit befinden wir uns mit den Fonds 5 und 6 im Markt. Beide richten sich an semi-professionelle Investoren ab einer Mindestanlage von 200.000 Euro in dem Europaprogramm 6 oder eben 300.000 Dollar in dem US-Programm 5. Wir sind dort eben noch wahrscheinlich auch bis Q1, Q2 offen für neue Investoren. In beiden Programmen planen wir 6 bis 10 verschiedene Zielfonds zu investieren, sodass eine Streuung von 60 bis 100 Unternehmensbeteiligungen erwartet wird. Also ein gut diversifiziertes Programm in den großen Volkswirtschaften Europa und USA. Was das Europaprogramm betrifft, nur ganz kurz als Update für die Investoren unter euch, die dort Interesse haben oder engagiert sind. Die ersten beiden Zielfonds mit One Peak Partners, einem sehr spannenden paneuropäischen Growth-Investor, sind erfolgt. Das zweite Investment ist in DPE, einem Spezialisten für die Dachregion. Und wie ihr farblich auch abgesetzt erkennen könnt, wir haben ein On-Site, also quasi ein sehr finales Prüfungsprozedere bei einem weiteren Zielfonds mit Fokus auf Business Software in UK und 2 weitere, die eine Evolutionsstufe davor sind, einen Generalisten in Paneuropa und einen Generalisten im Small-Cap-Bereich auch in UK, die sich in den Stufen 2 befinden. Das nur schemenhaft dargestellt, dass wir eben auch weiterhin diesen sehr rigiden, schrittweisen definierten Prüfprozess auch durchführen. Das ist mehrstufig und das Gute ist, dass diese Art der Philosophie der Selektion auch gespiegelt wird mit unserem Partner Trimbridge. Das war Bestandteil der Frage, mit welchem Partner in den USA wir uns zusammentun möchten im Rahmen unserer mehrjährigen Prüfung des amerikanischen Marktes. That should be it as a brief introduction, guys. So that brings us to Trimbridge Capital, where I would turn over the microphone to my colleague Oscar to introduce you guys.
Yeah, thanks a lot. Well, thank you, Julian, and thank you, of course, Brian and Matt. And for the audience, we have the pleasure for the first time to lend voices and faces to Twinbridge. Twinbridge, as Julian said, is our strategic partner for investments into US small and mid-cap private equity funds for our German investors. And we kicked off this collaboration just about a year ago, I think. Before that, we were, of course, in a very elaborate sort of getting to know phase that culminated in the partnership that we finalized about a year ago and then kicked off our joint effort ACF V, which is our first US small and mid-cap fund. So Twinbridge has been around a bit longer than Astorius and has managed more money than Astorius. So they serve as an example for us. And what they have achieved in their market, US small and mid caps, is truly astonishing for a multi-manager program. And so we're thrilled to have this partnership with you guys. And thank you very much for joining us today. So by way of quick introduction, we have Brian Gallagher, partner and co-founder of Twinbridge, who has had a long career in US private equity before co-founding Twinbridge with Joe and Pat. And we have Matt Petronzio here, partner and a small cap specialist who joined Twinbridge to extend the firm's reach into, say, the more small cap end of the market. Very exciting addition to the partner roster there. And with that said, I'd say let's jump into our main discussion. 2020 has been a year so far of many, let's call it, excitements. And let's look at the presidential election that happened. Well, was it only a week ago? It feels like it's been forever. This was surely an election that was widely followed all around the world, including the count that some consider still ongoing. How do you guys feel that this is now sort of over?
Well, thanks very much for inviting us to participate in this, Oscar and Julian. We're equally thrilled about the partnership and look forward to many years investing together. 2020 has been a pretty strange year all the way around, a difficult year all the way around. In the US, we always knew we had a pretty divided country and a fractious election ahead of us. It is good to have it behind us, although it's not entirely behind us. There is still some residual back and forth with some of the key states, but it appears that Joe Biden is the president-elect and will be proceeding to take office in January. It also appears that the election resulted in the Republicans retaining the Senate, although that's not yet done. There are 2 races uncalled in Alaska and North Carolina, and 2 races where a runoff is required in Georgia. The consensus, the belief at this point is that those 4 seats will be Republican. The House Republicans picked up some seats. The Democrats will probably retain control of that House. So it will be a divided government at some level for sure. And that's a good thing, we think. And we think most investors have concluded the same. The public markets reflect that thinking, that nothing too aggressive can get done, nothing too dramatic can get done. Our government is designed for checks and balances and back and forth. And most people are in the middle, not at the far ends of the right or left. So there's been some talk about some overriding legislation that I don't think will occur over the next 2 to 4 years. And, you know, for us, the COVID pandemic has been very difficult, as it has been for everybody, but we're very heartened by how our portfolio has managed through thus far. We think we invest with some of the smartest and most adaptive minds in private equity. And to be honest, we were, like everyone, fairly concerned about the portfolio and concerned about overall health and wellness in the US and around the world in late March and April. We've never been through a cycle like this. This is a very different and very dramatic downturn that we've all encountered and are still managing through. But as we sit here today, we're very happy with how the portfolio has fared. And this is across all of our funds. We still have activity in our first fund going back to 2005. And so we believe in private equity, and we'll talk a little bit more about this, is an asset class that should be consistently invested in. It's an asset class that does have the smartest, most impressive minds and asset managers, I think, of all asset classes. We like the middle market, where there are a lot of levers to pull to drive value creation. And, you know, we think in good times and bad, private equity, especially the way we do it, the way Astorius Capital does it, is durable and outperforms.
You've mentioned these adaptive minds with the specialists that you invest with. So given that you're in the market now for decades, how adaptive are you in terms of elections? Does this change things? Does you adopt in terms of investing? How reactive are you in the way that election results can vary?
That's a good question, Julian. And the short answer is we can't control what goes on in politics. We can't control what goes on in the broader economy. We can only control what we do. We can only control the selections we make. We are very much a proactive manager. We are always trying to get in front of the best funds across the entire landscape in the US. And we're very much a ground up investor, meaning we always have a top-down approach at some level because we want to be diversified across time, industry, across the geographies of the United States. But ultimately, we're looking at managers, and we do like specialists by industry if we can get them in healthcare or consumer or financial services, you pick it. But we are always looking for managers that have a great story, a great team. They have And a lot of this is the art and science. The science of track record is one thing. The art of interacting with these managers is another. But we are looking for groups that have unique angles to sourcing, because everything's competitive, but there are lots of ways to win. We want groups that have tremendous operational skills. They have tremendous access to managers, CEOs, COOs, CFOs, so they can really supplement the C-suite. We look for managers, and every time we look at a fund, we deconstruct every realized and unrealized deal, meaning, how did you source that deal? What did you see in that deal? Why did you want to own the company? What were your plans? And where are you relative to those plans? And you really get an understanding as to how unique and different and value added that manager is. So our approach, to kind of answer your question more succinctly, is it's top down at some level, because we're always conscious of what is the diversification within our portfolio, because we want to be diversified. We don't want to be over diversified. And we deploy over a multi-year period. We deploy in various industries, but the actual manager selection is very much an on the ground, interactive, highly diligenced exercise. And the one thing we certainly want to convey to everyone on the call, we only do LBO funds in North America. We do co-investing as well, but we only do LBO funds in principally the middle market. We have done this for more than 2 decades together, and we think we know this space as well as anyone. We think the private equity asset class is a must-have, and it's growing as a must-have. But if you're going to be in private equity, you have to be in the middle market. It's the largest, most consistently investable space. It's also the area within private equity and within alternatives where the greatest alpha can be generated, the greatest outperformance can be generated. And that's also what we look for in a manager. We are trying to find groups that have very, very low loss ratios. Losses do happen, it's reflective of risk, but we are looking for groups that disproportionately put up full realizations within their portfolio that are 4 times, 5 times, 6 times money. That's the performance. Those are the drivers of the portfolio returns that we really seek.
If I might add something quickly.
Sure.
So Brian obviously covered a lot there. I think we are manager specific and manager focused, obviously, but we build durable multi-strategy, multi-vintage portfolios that are meant to withstand economic cycles as well as any political variability, right? So we're more mindful of the long-term economic prospects for the companies and the underlying funds that we target versus any one administration. And to go back to this sense of sort of gridlock, if you will, that we'll have by split parties, it actually brings everyone back to the center and focuses them on where they can compromise, which tends to be much more productive for our economy, much more stabilizing for investors, and certainly gives our investors, our managers, better visibility for the next 5 or so years, which is the typical hold period for an investment. So.
And
well, I have to.
I was just going to say.
Please go ahead, Brian.
We certainly want to convey that we do follow everything we can, including politics, and we follow legislation. And for instance, in the healthcare space, of which we do a fair amount, we're very conscious with our sponsors of what's going on with pending legislation, with Obamacare and Medicare reimbursement and those kinds of things. So that is a big part of all of our diligence and all of our thinking.
So maybe just jumping in on that, I think today is the Supreme Court hearing on the Texas case that will be quite decisive for the future of Obamacare in that sense. Given how much healthcare is really a focus sector, especially now in pandemic times and so on. But what is your outlook on what's going to happen, one way or the other? How is that potentially affecting the healthcare, say, macro topic that we've seen over the past few years in many funds.
Yeah, that's a significant case, but and we've read a lot about it. We've talked to all the healthcare equity groups that we invest with, of which there are many, and we have a lot of friends in healthcare private equity funds in which we're not invested. Again, all of whom are very smart, very connected. I think the consensus by far is that this Supreme Court decision will not do anything, regardless of how the decision is rendered, will not do anything to alter the trajectory of Obamacare. Obamacare will not go away. And the Supreme Court has a long, long history of dealing with one part of a law that becomes problematic without wiping out the entire law. And practically everyone in America knows, including all of Congress and the entire Supreme Court, that Obamacare has been on the books for 10 years. It is thoroughly woven into the fabric of the United States healthcare system. I don't know how it can be unwound by the Supreme Court. And notably, the Republicans who would like to unwind it don't really have a great alternative. And so, of course, the practicalities of unwinding something that big and that elaborate without a well thought out, well structured replacement is pretty difficult. So not clear where the Supreme Court comes out on this, but the notion that it's going to completely alter or eliminate Obamacare is not the thinking of anyone we know.
And Oscar, as it relates to the way that our healthcare funds typically invest, they're more often than not looking to either take cost out of the system or provide care to a greater population of people in a more efficient way at a lower cost. So they tend to be in the path of progress, and any changes that may come from spending is just coming from one pocket or another. Obviously, the government drives the largest share of that spend in Medicare and Medicaid, and that dictates pricing and how dollars are spent. But key parts of Obamacare, like for mental health parity and those kinds of things, they're here to stay, as Brian said. And but we're focused on managers that can deliver care more cost effectively in the path of progress. They're not taking bets on where the next place to invest might be. They're very steady and focused on those long-term trends and where they can be, again, taking cost out of the system.
Okay, so basically we can just state for the audience that as much as there was a lot of excitement around the election, say in the past few weeks, and especially in the last week, from your perspective on the ground in the US as a long-term equity investor, it's not exactly a non-event. That would probably be taking it a bit too far, but it's not, the outcome one way or the other is not really, keeping you up at night, given that you allocate to managers who you pick for being able to generate, superior returns regardless of, say, macro environment being the, say, manager alpha seeker that you are.
That's absolutely correct. We, you said it very well, Oscar. We are very conscious of what's going on as a backdrop in all things in the United States, particularly politically. But if you consistently buy good companies that you want to make great, that transcends any political backdrop. That's the thinking that we've always had.
Obviously, good management of the healthcare system today with COVID is first and foremost, right? I'm not sure that one administration versus the other would change all that much. I would say we're kind of, depending on what happens with the Senate, if the Republicans hold the Senate, then we kind of will be in a Goldilocks period. But I think ample liquidity, low interest rates, and the banks are kind of lending as they were pre-COVID. Those things are much more impactful on our sponsors' ability to make good returns than anyone in the White House. So
next to the, say, presidential election, the one big P for 2020, the pandemic was actually the second big P that we were interested in in getting your views on in terms of what you've witnessed, say over the course of the year so far, what you've seen in your existing portfolios, how GPs have kept you in the loop, if there were any casualties yet, or how generally portfolios are behaving and holding up. So I think that's certainly the other big thing of 2020. So maybe you already touched on that, but how has that part of the year been from a portfolio perspective?
Yeah, as I mentioned, the first thing we did in mid to late March was assess with our sponsors and look through every single portfolio company. The very good news, and this is how we manage, we do not really do much investing in the most vulnerable parts of what have hit the pandemic. We don't do a lot of travel and entertainment and leisure and those types of things. That just doesn't lend itself well to our model, which is very LBO cash flow driven, very acyclical, not really dependent on discretionary spending. So we haven't had a lot of exposure. We have had a little bit to the restaurants and fitness spaces, but even in those cases, our sponsors have pivoted very, very well. Like in the case of the couple restaurant exposures we have, they have really pivoted to take out dining and some really great brands that are more drive-through driven. But it's a very, very small part of our portfolio. We are the methodology we employ in selecting funds and ultimately the deals that are selected, it needs to be not only durable, but these are must-have businesses. These are must-operate businesses that are very high margin, very high cash flow. They need to exist. And so we have seen very little damage thus far. We are not out of the pandemic, obviously from a health perspective and an economic and financial perspective. So we're constantly monitoring things. But the percentage of our portfolio, a lot of what happened in private equity was people assessed their portfolio in red, yellow, and green. Green is unaffected, if not doing better during COVID. Yellow is affected somewhat in the near term, but we still think the multiple of money long term, maybe a little bit longer hold, will still be there. And then red is definitely affected in the near term and probably affected longer term in terms of the final outcome. Our portfolio, as we've assessed from mid-March forward, has been more like 5% red and 10% yellow. I mean, it's just been very, very de minimis. And all we think about is, we think about IRR, but we really, really think about multiple of money. And we've been through many cycles, none like this, certainly. But if you can manage through your business and get it, through to the other side, you usually can take market share, and there's some good outcomes that can be generated.
Now that's looking at the portfolio that you had in place. Our, say, joint portfolio is, of course, knock on wood. No, it's not knock on wood. It's kind of safe. Thank God. It's a sort of post-pandemic portfolio in a sense that it did not enter 2020 as an invested portfolio, but it's now being invested. You're now deploying to new managers who have yet, for the most part, to invest into companies. So how do you view the investment environment following the pandemic, or say, if it's not really over yet, of course, then, the current environment? Is this now a particularly good environment in terms of entry opportunities, or is it, is it like periods you've seen before? How can we think about that in the context of the portfolio that we're now investing together?
Well, we believe you need to consistently invest as much as you can and be measured and deploy, methodically over every single year and over a multi-year period. But there's no question that, in our experience, when you go through recessions and cycles, that through the cycle and early coming out of the cycle, there are better and more opportunities to invest. Some great businesses with reduced revenues and EBITDA will not sell because they know they can get through and recover and then sell the same multiple with higher and normal revenue and EBITDA. But there are always opportunities to invest in the down cycle, and it requires some fortitude, because a lot of people get a little bit panicked about what's going on and they want to see everything excuse me, cleared out before they invest. We think there are some interesting opportunities that are presenting themselves right now. We've seen deal flow pick up measurably in the last 6 to 8 weeks, and we expect that to continue. Now, prices for those businesses are pretty high, so we're very conscious of buying right. But again, purchase price multiples matter a great deal, but what sponsor can and will and plans to do with a business is far more important. So there have been some interesting opportunities that have come up just in the last 2 weeks.
I would say it's a perfect time to have the portfolio where it is, meaning poised to invest into the recovery. I think that everyone is cautious, right? The good news that we got yesterday about Pfizer was very encouraging. Before that, we were all very, I would say, cautious about where we were headed. I mean, obviously we're all still concerned, but that obviously provides a different perspective. But when you think about the quickness of the recovery, the rebound was very, very rapid, and that's thanks to trillions of dollars of stimulus. Obviously, from March to September, the difference is incredible. We employed 11 million more people than we did. We lost 22, we brought 11 back. So it's pretty amazing to think about that. But I think we're still cautious because purchase price multiples are where they were, and leverage is where it was. And so I'm more cautious maybe than even Brian is, but we want to be certain that we are truly in recovery and not just sort of in an in-between period. But his point about being consistent in the market is very, very key, because the best returns tend to be following financial issues like this. And so if you pull back the reins and don't make any investments, you'll miss the recovery. And so we need to be prudent and be slow in our deployment, but also be consistent. And that's what we intend to do, and that's what the managers that are in this fund will do through the recovery.
Given the fact that these fund programs tend to have a life period of 10 to 12 years, first of all, we realize that you will see at least 2 or 3 presidents during that time frame. So the short term of a certain election shouldn't be the driver of investment decision. And the second is that now that we've seen, there's always the potential of a big external crisis factor that has not been foreseen, just like we've seen with Corona, COVID-19 now. We must have this calculation within this 10-year time frame that there's another crisis coming around the corner. So it's not only about the potential of the upside, but also the downside protection. And what we've seen in our program, where the companies that have been downwritten compared to the companies that have been upwritten during the COVID crisis, it's approximately a coin flip, so 50-50%. And what we tend to talk to our clients always is what happens in the next crisis. And this is a chart that we've used over the last months to show that the resilience of small mid-cap companies, at least in our portfolio, has shown that you're even more protected against large cap deals that always has this appearance or the myth of being bigger and therefore being less risky. Can you comment on that in your market and your experience, and what have you seen in pricings in terms of your existing holdings that we are not part of yet?
Yeah, that's an interesting chart, and we agree. The large and mega deals disproportionately are priced in the well into the double-digit EBITDA multiples, which means by extension, they tend to have very, very high leverage ratios. You'll see average purchase price multiples in the large and mega buyout funds, often in the 12, 13, 14 times EBITDA. Our average purchase price multiple is in the 10 times EBITDA, plus or minus. The average leverage multiple among large and mega tends to be 6.5 to 8.5 or higher, which winds up being high yield, highly syndicated, lending syndicates that can be very difficult when you have to restructure and negotiate. Our leverage multiples tend to be 4 to 5.5. And in our markets, and we spend a lot of time with sponsors on this, we want them to not take too much leverage. Leverage is helpful to returns to a point, and then it's problematic. And the lenders that our sponsors work with are middle market specialists, relationship driven, often will take a co-investment piece in the deal. They are looking to be collaborative, cooperative, and to get the company through to the other side of the crisis, the other side of the cycle. So that goes a long way toward impairment and final loss ratios. And like I've said at the beginning and a couple times, we invest in companies that we think are must-have businesses. They're high margin, they're high cash flow. They don't depend on, most of them don't depend on hyper growth. They can get through to the other side. And so we think that there's a misperception that you have safer equity in the large and mega buyouts, and we don't think you do. And you have better returns, of course, in the small and middle market space. And every great buyout fund, the Blackstones, KKRs, their greatest returns were in the middle market, lower middle market, where we operate, where Astorius operates. They got to be big because they were so great as middle market, lower middle market shops. And the returns are still good. They're just not nearly what they were when they were smaller. It's not a surprise.
So even when risking that it sounds slightly boring to some of the attendees, but the most general rules still apply that pricing is critical, competence is critical, and that will navigate through whatever crisis may come around in the next 10 years' time. And that's the core you're focused on when selecting fund managers for us, which kind of is reflected in the philosophy that we share with you guys. We had a bit of a break in terms of investing over the months of March, April, May, and June. So even with our Fund 5 that we've been fundraising now for a couple of months, even before the Corona crisis started, we just now recently started investing with you guys. We have made the first 3 fund investments, and we have a brief description of each one of those here in the portfolio. Would you like to comment on each of them? What makes them special? How do you wind up with these guys in terms of investing?
Sure, and I'll take the first one, Blue Sea Capital. So Blue Sea is a West Palm Beach headquartered fund. They have 2 main strategies. They focus on healthcare services and they focus on high value industrial, but it's a very thesis driven investment strategy. Interestingly, they're raising their second institutional fund as Blue Sea Capital, but Brian and I and the rest of the team have known them for 20 years plus from their predecessor firm, Brockway Moran, which was down in South Florida as well. So Fund 2, but very, very experienced investors with a deep track record of success in their respective industries. They're also $25 million investors in the fund, so they've contributed meaningfully to their own cooking. They're eating their own cooking, if you will. We have invested with them not only on the fund side multiple times, but also co-invested with them. So we have a very deep and longstanding relationship with the principals. As you know, this is a people business. And so it's our job to really get to know what makes them tick and to be well positioned to be not only advisory board members and also board members of the underlying portfolio companies that they ultimately acquire. The fund is going to be at its hard cap of $400 million this month, I think, or maybe in December, but very nice fundraise, very successful raise from myriad investors around the world. They also already have 3 companies in the portfolio, so we're able to offer Astorius investors an opportunity to walk into a pre-populated portfolio, one of which, Innovative FlexPack, the first company listed there on the page, is already marked at 1.4 times and should be marked probably at 2 times cost by the end of the year. So there's meaningful appreciation in that business that will accrue to the benefit of investors in short order. Leverage has been paid down to maybe 1.5 times or less. So in the next 12 months, there will be a dividend recap that will return meaningful capital, and the company is off to a very good start. But they also have 2 other businesses that are also performing quite well and have been beneficiaries for the most part of the COVID environment. So we're very pleased to have this one in the portfolio.
Okay, thanks. The second one is CIVC.
Yeah, so Blue Sea gives us healthcare and really industrial services, not so much industrials. CIVC is truly a business services play. We have invested with CIVC going back to Fund 3 at our predecessor organization, PPM America, which is wholly owned by Prudential UK. CIVC has a long history going back to Continental Bank, one of the original money center banks in Chicago, which had a lot of private equity talent that went on to form great firms all over the country. We have invested with these guys, Funds 3 through 6 now. They actually, and we know all the contours of the partnership, they previously did some financial services investing, which led to a little bit more volatility than we liked, but the returns remained exceptional. They have concluded that it's really not the right vertical for them to do financial services going forward. So we actually think CIVC's numbers, which you see here, are tremendous, are good and getting better. So the vast majority of the businesses that they invest in, an example would be EN Engineering is listed there. They do repair and maintenance for utilities. Yellowstone does landscape maintenance. These are recurring revenue models that are EBITDA margins well into the double digits, cash flow conversion, usually in the 80 to 95% range. I also want to point out as we convey how we think and what we do, we look at fully realized results as the most representative of what that sponsor can do. So unrealized results are interesting. They're not the most important thing. It's when the final outcome is fully done, no more cost basis dollars are yet to be realized. And you've seen in the Blue Sea numbers, 4.4 fully realized. We know those numbers because we know the team, we know the predecessor organization. We have the ability to deconstruct and get the diligence to ensure that those are really their returns and they're not leaving anything off the returns. The same applies to CIVC. We've known these people for more than 20 years. We've watched the partnership transition. We really think we have way more knowledge than the vast majority of our peers. So CIVC, reflective of the numbers and the transition that they've made, was a 1 close, very oversubscribed fund that literally wrapped up last week.
Okay.
So we're really pleased to get a nice allocation for both us and Astorius.
There was at least $1 billion of demand there.
And last but not least, the STG fund.
Yeah, so STG gives us technology exposure, and we like technology. We like it in a certain way. We're not growth people at all. We're leveraged buyout people. We want proven cash flowing businesses that have every reason to grow and exist. This isn't a concept that's yet to be proven. STG has been around a long time. It was originally part of a family office. Starting in Fund 4, they just began the transition to a fully institutionalized firm. And we have known them a long time. We really got keyed in on them going into Fund 5 and committed to that fund several years ago. This fund, same situation, 1 close, massively oversubscribed. It's a little bit larger than we normally do, but the vast majority of deals they're doing are enterprise values of 250 to 500 million, which is still the middle market by any definition. The bulk of what they do is software as a service, truly recurring revenue, gross margins of 90 to 95%, EBITDA margins of 30 to 45%, free cash flow conversion of 90+%. And these are higher priced deals, but they're also incredible businesses that are perfectly suited for consolidation by strategics, where you can get considerable upside through multiple EBITDA multiple expansion. So this fits us really, really well. We think we made a very adept call going into Fund 5, and everyone else caught on, and Fund 6 is way oversubscribed.
Given that you've mentioned the term oversubscription now multiple times, how do you see the fundraising environment now through this whole COVID-19 period, through the president election? Has anything slowed down, or for the leading talents, has nothing changed at all? What's your perception of that?
It's been interesting. The fundraising market has been very robust. There was a little bit of a pause, of course, in March through June, but the fundraising environment's been very, very robust the last 3 to 4 months. There's no question that the very best equity groups with consistent long-term returns have been raising no problem, even if new investors have to do everything by Zoom. New funds, first-time funds, funds that don't have the same returns, the same history, are taking longer, for sure. So it's a little bit of a have not dynamic within the US, and we don't really see that changing. But if you have a chance to invest with a great sponsor, you have to take it. So the best names are raising no problem, and lots of funds are way oversubscribed.
Okay, well, we got a couple of questions from the audience. Given your personal investment in the funds, do you have the same philosophy as we do, that you have proprietary investments in all your own fund of funds that you launched and you invest with?
It's without a doubt, all of our funds, we are big commitments to the GP. It is easily the most significant investment in our entire portfolio. We are totally aligned with our investors.
You can ask my wife.
Yeah. We are very
fully invested.
We are very happy to do that because we think the returns are compelling, and we'd rather be in our funds than the public markets. So speaking just for myself, I continue to leave my public market exposure alone. I just keep putting money into private equity, in our private equity.
One investor agrees with you about potential investment opportunities in the financial crisis. Still, this seems different. We never had a crisis with such an amount of liquidity in the market. Where and why do you see other opportunities than in normal times after a normal crisis, if there is any such thing as a normal crisis? But is there anything different in this specific market environment now?
I think it's definitely different in that the uncertainty hasn't really gone away. In normal recessions, it follows a typical dip and recovery, and the contours of that cycle are pretty clear because they look like prior cycles. There have been pandemics in history, not in our lifetimes. I think that's true for everyone on this call. So the uncertainty is giving a lot of people pause. It's making us think and rethink what we're doing, but it's not paralyzing us, and it's not keeping us out of the markets.
I would say that it's not like there are more opportunities today. I would say, in fact, there are probably fewer, as there should be. There's the spread between buyer and seller expectations that happens every time there's a correction. And that pause is good and it's healthy. And that's why we have 5-year investment periods in our funds, so that you can be patient and you can find the opportunities selectively when they come. We don't need to deploy the capital right now. We'd like to, but only if the sponsors are finding opportunities that are truly compelling and with the right pricing expectations based on the uncertainty in the market for the next 9 months or 12 months. So we're bullish because we've seen our sponsors perform really well through these types of environments before. Obviously, this is different. We put ourselves in recession in this case. We took an economy that was growing over 3% and slammed the brakes on. We were very worried in March, and there was essentially a run on the bank. until the Fed stepped in and the Treasury stepped in and provided that liquidity. But today there is a lot of liquidity in the market, as much as there was before, maybe more. And so that tends to have countervailing effects that are not necessarily positive for investing. So we need to be careful, and we need to find good opportunities. But that's what our sponsors are best at: sourcing unique opportunities when other people can't, adding value where other people don't see value. And so by being able to access these high quality managers, it puts us in a position to, outperform coming through this cycle, however it pans out in the end.
We have another question from someone who is, in a sense, a colleague or former colleague, as a former GP in a buyout fund himself. And he's asking, how is it that, funds, especially the ones who are doing well, tend to increase their fund size over subsequent vintages? How can you keep following managers when they sort of, leave the mid-sized market just by virtue or vice of their own success? And I think this STG example that you mentioned is probably nice of someone who's stayed sort of disciplined when the Thoma Bravos or Vistas of the world have clearly left that space. Maybe you can elaborate a bit on that.
Yeah, we're very conscious of fund size increasing, and of course it's a natural thing because management fees, can be very attractive to all sponsors. We're ultimately driven by multiple money and performance. So the bar, when a fund gets much larger, the bar gets much higher for us. And we really have to believe as a group that the playbook that the sponsor employs to drive the outsized returns is still effective if you're $1.5 billion or $2 billion or bigger fund. So the underwriting becomes a little bit more rigorous. We think we always apply a lot of rigor to our fundraising, or our underwriting rather, but for a fund that's getting much bigger, we really sharpen our pencils and spend a lot more time on the operational improvements and the unique attributes that historically have driven returns, and we have to have conviction that those unique attributes still apply.
Yeah, I think we wholeheartedly subscribe to that ourselves. Julian, maybe if you can switch back to the slide we had before, just because we have one question here that is about, say, different regions across North America, or say the US. We have this little map included on the lower right where we can see the funds that we have allocated so far, sort of nicely, kind of triangulate the US as it is. But do all these GPs operate, say, nationwide? Are there, specific regional approaches? I know we looked at one manager who is specifically strong in the South. What's going on in these portfolios?
They're mostly national in scope.
Yeah.
Some of them, have probably a little bit more sourcing locally. CIBC has a lot of connections in Chicago and the Midwest. But I would say, the vast majority of their portfolios across the country. STG, because they're technology, there's probably a little bit more distribution on the West Coast where there's a higher concentration of software businesses, but we know they have investments all over the country. And the same thing applies on regional sourcing. Blue Sea knows a lot of folks in the Southeast, so they probably get a little bit more exposure to the Southeast. But if you talk to any one of these sponsors, if they find a good business that's 2,000 miles away, they have no problem hopping on a plane and buying that business.
I think
two
of the first deals in Blue Sea's portfolio, one's in California and one's in Utah. So
okay,
they're all over. Yeah, if you look at our entire portfolio and how it distributes across the United States, you'd see, dots all over the place. They're everywhere.
Very good. So also the portfolio that we're now investing will really be a true pan-US, sometimes reaching into Canada portfolio.
Mm-hmm. Yeah, occasionally reaching into Canada. That's right.
We have another question regarding the ESG. This is a topic that has become even more popular over the last 12 months. So the investor wants to know how ESG is reflected in both the Astorius portfolio and the Twimbridge portfolio. I would just briefly answer that there's a specific list of industries that are excluded from the investment strategy from Astorius. We are more than happy to share it with you in terms of interest. So we don't sell ourselves as a impact investing ESG manager, but there's a very strict and rigid guidance in what industries we can and will invest with, making us investable for especially investors with a clerical church background, which has been the biggest driver among the own will to fulfill these requirements. But how is ESG reflected in your portfolios with Twimbridge funds?
Sure, and it's an important topic for everyone, including us. We have a formal ESG policy that we adopted years ago and devised that policy with the help of our attorneys at Kirkland & Ellis. ESG is a part of all of our underwritings for the funds. But the bigger picture is we're very, very conscious of what these companies are, what they do. We want companies that would never harm the environment in any way, companies that are very focused on social and governance and doing all the right things in all the right ways. It's a huge part. Even without an ESG policy, it's critical that the companies in our portfolio are good corporate citizens doing all the right things in all the right ways.
We have one last question from one of our friends from Austria. Due to the fact that massive liquidity is in the market, how do we respond to someone who is pondering on the excessive cash in the market? Is the market overpriced? And isn't it especially overpriced over in the US? What's your comment on that perception?
That's a good question. I mean, we feel like markets are pretty rich and are fairly highly priced in the public markets for sure. As we talked about a few minutes ago, our purchase price multiples are considerably below the public markets. They're considerably below large and mega buyouts. Purchase price multiples in our space are larger than they were, 5 years ago, 10 years ago. Part of that's just more money's in the markets. Interest rates being incredibly low can drive some of that. The debt service that applies to a lot of our businesses is actually lower because the interest rate is so much lower. But what we really want to convey is that we, for our markets, it's purchase price matters, but a lot of times we're looking at businesses that do a lot of acquisitions. And so they're taking a headline EBITDA multiple and driving it much, much lower over the course of the investment. But as we talked about earlier, the art and science of this, we want groups to be investing in businesses where the science is kind of straightforward. These are good businesses with, high revenue growth, high margins, et cetera. But they have a toolkit, a playbook, sorry to use all these cliches, but they have a point of view on why they want to own this, what they can do with it, and why they're going to make it a great business that is a must-have for a strategic or larger financial buyer. And if you have that point of view, good things tend to happen. And given what's happened in the public markets, we're not public market prognosticators, but there aren't many folks who think the 2020s are going to generate tremendous public equity returns given where valuations are at the start of 2020. So we are big believers in private equity. We always have been, we always will be. We're unwavering, we're always trying to get better. But we think there are compelling returns in our space.
Well, thank you so much. Just maybe to give people a feel for timeline and status of our fund, in our last interim close that we had last week, we almost hit 90% of what we set out to have as target into our fund. So it's been really a great journey with you so far. So once we hit our target, we still have some room until we hit our hard cap. So the fund is still investable. The portfolio is coming across nicely. We've seen really impressive numbers from the first three managers that you've been able to allocate to for our fund. And so, no, we can just say thank you so much for joining us today, making time in your calendar, and for doing the great work for our fund that you do. You're great partners. We're really looking very much forward to the coming years together. And since we have no more questions, we thank our audience for being with us this afternoon. And if there are any questions, please reach out to us in Hamburg and Frankfurt, and we can channel more questions and comments to the US, to our colleagues there. So thank you very much, Brian and Matt, and thanks for everyone for dialing in. Everyone have a great evening. Thank you very, very much.
Thank you.
Thank you.
Bye. Bye.